Hello, welcome to our webinar here at Sterling Trading Tech. We're going to start in a few seconds here as I see more participants in the audience are joining, but definitely wanted to welcome you to our webinar on trading safeguards, enhancing security with OMS risk controls. My name is Mike Baradas. I am the product manager for the order management system, the OMS, here at Sterling Trading Tech. We are a leading provider of professional trading technology solutions for the global capital markets, specializing in three distinct product lines: trading platforms, risk and margin system, and the order management system, which is today's webinar topic. Now, before we start, we just wanted to ask like a few poll questions that my colleague will be displaying on your screens. You should be a Zoom screen. And these are just basic questions. It's just three questions. If our audience wouldn't mind taking just a few seconds to fill them out, just to get a better understanding of our audience on today's webinar. And I'll try to customize definitely the product demonstration to be more relevant for those of you in the audience. So maybe we'll just take, let's say, another 30 seconds as the answers come in. And then at that time, my colleague will post the results of our answers. Oh, okay. All right. So let's, I'll just quickly go through these. You should see the results as well. But good. So it looks like in terms of the firms that each of you represent, it looks like we have a good variety here, buy side, sell side, and other types of firms. So good. That's good because regulations definitely apply to everyone, you know, in the different markets and exchanges, asset classes, countries that you're involved in. So that's good to know. We have a good distribution of firms participating. Second, in terms of asset classes, okay, good. So equities and options. So we'll definitely go through examples in the demo on equities and options. And it's very helpful for us to see the interest in the other asset classes that are there. So that's definitely going to help us. But good, good. So we'll definitely cover equities and options in our demo. And then lastly, let's see, in terms of the different platforms that people are using. So yes, I mean, this is what we hear from customers, that is not just the order management system that has the risk controls. It could be an order entry platform, could be a risk platform, of course, and other platforms. So it's common. If those of you were wondering, if you're the firm that only has, risk limits like in different platforms, that's definitely a common setup that we see, that different platforms are managing the risk for them. So, hopefully I'll be able to make our view here known that you should probably try to centralize your risk controls into the order management system, and there's a reason why it should be the OMS. But certainly we are aware of the different setups that are out there, and where integration becomes an important discussion topic when firms are using our OMS. So thank you for sharing those answers. So I'll definitely try to refer back to these results during the presentation. Okay, so let's get right into like the presentation part. So I'll make this short because I know most people, especially myself, I'd rather see like a demo of the product, of all the different risk controls and the features that are in our OMS. But just wanted to kind of like, set the stage, set the framework of this webinar in terms of what we're going to cover. So in this word cloud that you see on my screen here, are all the different headlines that I downloaded and put it into this word cloud. And you will see like the more common words in the headlines begin to appear. I mean, obviously I removed all the firm names in those headlines, but as you can see, definitely the larger words, whether authority, meaning like different regulators, or a bank or an institution or an investment firm, is definitely prominent in headlines when there are erroneous trades. And then billion, right? Like the size of whether it's the size of the order or orders, that may have caused erroneous trades, or the fines, right, run into the millions of dollars when erroneous trades happen. I look as far back as 2001, so definitely it's been around, right, for more than 2 decades, where there are erroneous trades in different asset classes, different markets, and certainly run into the, like I said, millions of dollars or whatever, or euros, whatever the local currencies are, but certainly quite significant in terms of fines, and can be damaging to some firms. So clearly that's a reason for these risk controls and these regulations. And the primary reason, of course, that these erroneous trades are happening is the rise of electronic trading in our industry, the rise of technology, right? So I'm sure many of you have been in the business for a long time, including myself, where I started off as a trader at a bank, and then moved more into the technology side as more trading algorithms, more trading platforms, more automation came to the markets, and for good reasons, right? To bring more efficiencies to the market, bring more or make it easier to access different sources of liquidity, bringing more transparency to the market, whether it's for regulators in terms of reporting requirements, with audit logs and reports. So technology, of course, makes our industry better. It makes the markets better, better for the participants, better for investors, retail investors, institutional investors, the exchanges. It makes it all better. But anytime there's new technology, there are going to be some unintentional, cases where they weren't anticipated, and you could have these errors happen. And there's certainly a human element to it. So technology, of course, wants to help and support the human element, but mistakes happen. And so that's the reason why, you may have noticed, over time, there could be these erroneous trades that get reported that are quite significant. And like I said, sometimes damaging to a firm when these trades happen. So just, set the stage, set the context on what the industry is like. Next, come here. Just wanted to give like a high level overview of a life cycle of an order. So obviously the order started somewhere. Typically it's an order entry platform, whether it's a Sterling product, right, a Sterling trading platform, or your own, proprietary platform, or another platform, or an exchange platform. So the order is entered, and typically it will route to an order management system, an OMS, whose primary role is to route the order to get executed, and that order can be routed to an exchange, could be routed to a trading desk, right? Or it could be another liquidity provider, or another, or an alternative trading system. But it's usually an order management system that handles that routing to the platform to get executed, right, at each venue. And so, as you can see in this very simple, 3-step layout, there is a gatekeeper, and that is usually the role of the OMS to be that gatekeeper. And that's when the risk checks come in. So when we took a look at the OMS, the two primary responsibility of the OMS, first is the risk checks, and then second would be routing that order after it passes or rejects, right? Those risk checks. If it passes the risk checks, it'll get routed to the right venue, whether it be an exchange, a trading desk, or a liquidity provider, and even the time, right, that order gets routed. So we're not going to cover routing. We're going to save that for like another webinar, just to keep these webinars really short and relevant to the audience. So we're going to talk about the risk checks. I've listed probably 3 of the more common and standard risk check categories that you're going to find in an order management system, and certainly in ours. So price is, the fat finger price check, right, that we talk about in our industry, where the trader or the user wanted to buy a security that trades at $10, they enter a price limit of, $100 or $1,000, right? So, they put in 1 or 2 extra zeros, and for a liquid security, it could get filled at $10, which is where the market was. But certainly for an illiquid security, it could certainly move the market, right? And that's when the erroneous trades happen. Size, very similar to a price check. This time it's in terms of, let's say, quantity. So very simple order. The user wants to enter 100 shares. Again, they put in a few extra zeros. They could be sending 10,000 or 100,000 shares or contracts, right? And then that will obviously move the market. So that's a kind of like size check. Sometimes the notional value, right? They meant to send, let's say, $10,000. Again, a few extra zeros, and it ends up being 100,000, $1 million. So for an illiquid security, that will certainly move the market and cause erroneous trades. And then the third one, it's probably more of a like an operational type of risk check, and this is what I mean. So while the OMS probably can't predict whether the trader meant to buy, to go long, right, or to sell, or to go short a particular security, um, it is possible to have like a risk check where, based on your current position, that the OMS knows that you're long the security. So you may not be allowed to sell short. Like your client firm doesn't allow you to short against your long position. So they'd like to be able to catch and prevent that, to make sure that the order gets marked as selling long, because you're long your position. In derivatives contracts, let's say like options, also important for operations and for exchanges to track, let's say, open interest in a particular options contract, where if you're long a call option, and then you enter an order to sell, to open another position instead of closing your long position, you may want to prevent that, right? So because the user really meant to close their position. Because long or short derivative contract, there's always that risk of being assigned, where they thought, oh, I thought I closed my long call option, so why am I getting assigned, right? So that's certainly a risk. Or they wanted to exercise, but in error, they closed out their position and they had nothing to exercise. So, so those are certainly important risk checks that might be more on the operational or risk side, or for an exchange. But certainly it is an important risk check that we're finding that customers find useful in their order management system. Okay, so let's get right. Oh, before we get to that, of course, there's a reason, right? Well, we have all these different risk controls in place in the order management system, and it's definitely important, right, to manage, the firm's risk, manage the a customer's risk or an exchange risk, but definitely these regulations come about, and I've selected probably two of the more well-known ones, more like umbrella regulations. So in the United States and in the EU, the FINRA market access rule in the US, sometimes you may hear us call that 15C35, or the Article 17 and Method 2 on algorithmic trading. You'll find that they have a lot in common in terms of having the appropriate, right? These are direct quotes, right, from the regulations, where firms are required to have appropriate risk controls or trading thresholds or limits, right, to be able to prevent, erroneous trades from being sent to the market. So the days of naked access to all these electronic exchanges and markets is long gone, and these are market regulations that your firms are complying with. And that kind of brings me to my second point. These market regulations also have a compliance requirement, whether it's reporting, right, that you're complying, or being able to demonstrate to these regulators that you do have risk controls in place. So very often we work with risk managers where they need to demonstrate, right, to their regulator that they're in compliance. So very often they actually have like a demo script, like a list of different risks that they need to control, that they need to manage, just like a price check. And we're always like showing them on the OMS how they can implement these risk controls, and so they can turn around and demonstrate to their regulators, that these controls are in place, and this is how we control them. So definitely, any market, any exchange, any country, there are market access regulations, and the risk controls are the ones that help, right, the firms protect the firms and their customers and be compliant with these regulations. So the typical person, like I mentioned, we speak to risk managers. It's a very simple requirement, a very simple request. They need to manage their risk, the firm risk, the customer risk, the exchange risk, and and also comply, right, with the regulations. So I talked a little bit about that, how our firms, our customers are able to do that compliance. And then taking like the common categories of our risk checks, price, size, and side. And then in the sub bullet points, I started listing out the different risk controls and features that I'm actually going to demonstrate for you of what we call them on our platform. So under price, I'll do some demos on how we do the fat finger price checks. Size, we'll do some cases where if a large order gets through, whether it's in terms of quantity or value. Duplicate orders is a popular one too, where an order for the same security, same side, same quantity, same price gets sent repeatedly. So whether or not that was intentional, I'll show you like how we identify duplicate orders and are able to actually reject duplicate orders from being sent. So hopefully that's something you're looking forward to. And then, like I said, side, probably more of an operational or like an exchange risk control, making sure that trades are getting entered and executed with the right long, short direction, and also for derivatives, let's say opening and closing. All right. So with that being said, I am mindful of our time, so we don't have a lot of time. I do want to get quickly to our product demo. So let me pull up our order management system. So I do see my order management system should be seen on the screen that I'm sharing. Okay. So I know there's a lot of windows out here, which I know you typically would expect from an OMS or trading platform. But I'll just give like a high level overview. So essentially, when you get enabled on our platform, there is at the top level a group where you can add multiple accounts that belong to that group. So in my demo platform here, that's what I'm showing you. And the reason being, there are group level risk controls, and we'll try out some of them that are available at a group level. And then at the account level, there could be additional risk controls that you may want to configure. So you see it looks very much the same risk settings, but you'll see there could be some additional ones, or there may be group level settings that you're not enabled for everyone, but you may want to fine tune some more conservative limits for like specific accounts belonging to a particular group. The other windows here, account opening positions, that simply displays what are your start of day, your opening positions when you start your trading day. And then here is a very simple order entry form, order entry window. We'll do some tests down here. We'll definitely do some examples where, once you have positions, once you have open orders, how do the risk controls work? And then this is probably more familiar, an order blotter, as orders get entered, whether they get filled or they get rejected and so on. And then here, this is a simple trades blotter, as trades get filled. So we'll definitely be working on a few cases here, but let's get right into it. So what I wanted to do was to start with the price checks, the fat finger price checks. So a very simple case here where, let me see, I have my account set up with no price checks. So that's under here, max price variation where nothing's checked. So if I had a liquid security, let's say Apple is obviously very liquid. So this is a demo platform, but it does have real-time prices. So just to make the demo more realistic, the prices that they should get filled at certain prices. So let's say the bid ask is $227.34 to 35 cents or something. And then just using like a quick simulator demo. So, order goes through, I get filled here 227.33, which was the ask, even though I entered a more aggressive limit. This is obviously Apple's a very liquid security, even if it's high value. If I enter some crazy number, like let's say, let's say 300, clearly through the market. But when I send it, it would still get filled. Oh, I ended up sending 2 orders. So even though I had a price limit of like $300, clearly through the market, you'll see that it got filled, at the offer because it's a very liquid market. So there's no risk there. But obviously, if it was an illiquid security, you want to make sure they actually get rejected. So Let me put in a price check here. When you look at max price variation. So this is a very simple price check where I'm just saying if I'm 5% through the market, so we'll look at the best ask price for a buy order or the bid price for a sell order. If it's more than 5% through the market, I want the order rejected. So let me put in an order where it shouldn't violate it. So like any good tester that I'm sure some of you do, I'm not too far through the market, less than 5% through the market. It should go through and get filled. Oh, and I've sent 2 orders. So it got filled right on the offer, even though, okay. But then if I go to the example that we did, when the risk checks were off, let's say 300, right? Clearly the price that is through the market, I would expect us to get rejected. Okay, so that's the last order that I just sent. My price limit was 300. Clearly it's through the market. So we also provide a reasonable, an explanation, a reason as to why it got rejected. So the user knows why it got rejected. So that's a quick demonstration of the price check. There are additional features. So, this is based on customer feedback where they want some more price checks in terms of, let's say a price level. So for a low price stock, they may allow, some more price variation through the market, simply because, a price tick on a low price stock is actually quite a high percentage. So let's just do, again, just for an example here. So let's say $4, I want to allow 10% through the market. Okay, just as a demonstration. Okay, so let me do for a low price stock. So Sirius XM, series symbol is like a $3 or something price. Okay, so trading at 350 to 351. So if you send it a price that's under 10%, I'm sending it to the ask price. This order will go through. Buying 1 share series. Order is in, the new order gets created. And if I put in an aggressive price, let's say $5 through the market, it'll apply that, which is more than the 5%, right, in the default value. So this one, we want to apply a higher or allow a higher price percentage. So this should reject the order. And then you get the same error here that it's been rejected. Okay, and so the same thing can happen as well. I'm just checking our time. I think we're making good progress here. So also a high price stock would also have the ability to set a price check. Okay, so let me move on, just so I'm able to show some other kinds of limits. Let me just disable some of these price checks. So the next one I wanted to go through was shares in terms of like size. So let's say I wanted to restrict the maximum shares entered per equities order to, let's say, just 5 shares. This is just for demonstration purposes. So I've been testing with 1 share, and obviously it goes through. So let's do a quick check again, where buying Apple, sorry, I just picked the prices just to have it as a trader, where if I send 1 order, it's less than the 5 shares limit that I put in, so it'll accept that order. Okay, order goes through and gets filled. If I send 5 shares, so it still allows it should still allow 5 shares to go through. So exact same order, sending 5 shares, and you see it goes through, it gets filled. But if I enter 6 shares, I will get rejected. Okay, the order exceeds the number of shares. Okay, so that is the order size price check. We do something very similar for a market dollar value for an order, and this works for equities and options. I did want to show you the duplicate order. So this is at the account level where it checks for a duplicate order being sent. So let's do a very simple one. Let's do go back to Sirius XM. So you'll see that if I send the exact same order to the simulator good, that if I send multiple orders through, you'll see that this third order got rejected um, because it identified that it was the same order being sent. And the way the feature works, essentially there's a timer in the background. So within a time range, in seconds, in milliseconds, it's able to detect if the same order is being sent, that it assumes it's a duplicate order and it'll reject the order. Let me just get through like one other example here in terms of a side, like those operational exchange or clearing firm types of risk limits. So I'll just do one for shares to keep it simple. So we have this order side marking setting that we have it set to enforce. Okay. So if I was to enter an order to sell short, so I just want to check a position, a stock where I don't have a current position. So I'm going to use Verizon. Um, okay. Where I want to sell along one share of Verizon at some price, simulator. I'm selling along. I don't have a long position in Verizon. And when I send it, I get rejected. It tells me, oh, your equity order is mismarked. Okay. So this account, again, you can set it that you allow short selling in an account. You can do a sell short. So it's setting the same order, but just changing the side to sell short. This should go through. And yes, it does as a sell short. So I know we're at our time, and I apologize that I went over it, but definitely, just wanted to give you like a quick looking ahead. Hopefully, this was a useful demo for you guys. So just looking ahead, we expect, just like you do, more regulations and compliance requirements are coming up that you need to comply with. You're going to require us um, and to have more robust risk controls built in your OMS, and that integration, just like you had responded, that there are multiple platforms that you're currently using, and integration is important across the platforms. So the demo that I gave you, that our order management system is actually API first architecture. So all those features and functions and even orders can be sent over API, is what our customers are able to do to integrate with their platforms. Of course, you can send standard fixed messages for inbound and outbound order routing. That's also available. But I know we're just a minute over our time. I did want to check to see if there were any questions. So let me check our Q&A box here if there are any questions. And looks like I think there are some questions, but let me answer a couple of them. One question is it easy for you to integrate with my platform or clearing firm? So the answer is yes. So my last point was just to say, the architecture is API first, and you can easily integrate with the platform, including routing orders, inbound, outbound with a fixed schema. So that's out of the box. Whether you need our API documentation or fixed specs, we're happy to share that with you. Next question, are you adding more markets? So just like in our poll, there's interest in other asset classes. So on our roadmap, we're definitely expanding beyond equities and options to other asset classes that we have ask you about, and also other markets, right, around the globe. So please definitely stay tuned for those announcements. And finally, let me take just one more. Yes. Are the risk controls applied pre-market and post-market? So yes, same risk controls apply pre and post-markets. In the price check, we actually offer an additional configuration you can do where stocks may be more volatile, right? Where prices or bid-ask spreads might be wider pre and post-market. So you may want to allow more room or be more conservative. It's your choice. You can definitely set price checks that are different in the pre and post market than the regular market, the continuous market. So definitely that is available. So I know we went over, and I apologize, but definitely appreciate you joining our webinar, and hope you found this session insightful and valuable. We'll definitely have more webinars coming out, so please look out for those announcements. Don't forget to follow us on LinkedIn for updates and more content. And we appreciate your time and look forward to connecting with you again soon. So thank you once again. My email is right there. If you want to reach out to me directly and learn more about the product, definitely I'll make sure we get back to you right away and we can connect. So thank you once again, and have a great day.